Now, in the relentless pursuit of overall portfolio growth, many investors are going to scour and search the market for undervalued stocks that are going to promise substantial returns. However, it's important to be aware that this hunt can lead them into the clutches of value traps. Now, these are stocks that are masquerading, hiding, pretending to be bargains, but they do conceal inherent dangers. Now, these tantalizing and yet flawed investments can actually swiftly undermine even the most robust and carefully thought out strategies. They can basically turn what may look like a savvy buy into a very, very costly misstep. Simply by recognizing and evading these value traps, you will do well, because these value traps not only erode capital, but they're also going to take up a whole load of your important and invaluable time. And this, my friends, is an asset that you will never recover. Now, astute investors understand that finding and identifying value traps and being able to tell a value trap from an real, genuine value investment, this is going to be key to safeguarding your hard-earned wealth from investments that are simply too good to be true, these true value traps. Now, by learning to navigate around these treacherous pitfalls, you will empower yourself to make well-informed decisions, and you're going to bolster and grow your ability to construct a resilient, profitable portfolio over time. So what is a value trap? Well, a value trap is an investment that's going to entice you. It's going to draw you in with a seemingly very low price compared to what appears to be a strong intrinsic worth. But the reality is actually far more sinister. These are going to be fundamentally flawed stocks that are going to be lacking either potential for growth in the long term or the potential for recovery in the short term. Now, there are a number of telltale signs that we will discuss today, such as declining revenues, deteriorating financials, and unsustainable dividend payouts. Now, differentiating between genuinely undervalued opportunities or great value investments and those that are cheap for a reason, because they're unworthy investments. Now, this is going to be crucial for you as an investor. Now, making this discernment involves looking beyond simple surface metrics like price-to-earnings ratios and actually investigating and exploring the company's financial health, their competitive positioning, and wider industry trends. Now, it's only really by grasping these nuances that you will be able to navigate this intricate landscape of stock investing and steer clear of the pitfalls, allowing you to focus on the opportunities with genuine upside potential. And this knowledge serves as a shield against costly mistakes, as well as a compass that's going to guide you toward some very sound decisions. Now, evading and avoiding value traps is going to demand a very rigorous and meticulous approach to your investment analysis. Evaluate a company's earnings consistency and their overall growth trajectory over several years. Now, any declining or stagnant profits could signal or be indicative of some underlying issues that will be important for you. You will need to investigate dividend payout ratios relative to the earnings growth, because high payouts might seem very attractive, but they could actually prove unsustainable in the long term without some robust profit increases. Also, have a very careful look at their debt levels against industry peers, because when there's much more debt than their competitors have, this is probably going to suggest potential future financial distress. You will also need to understand their overall position and sector health, because if they're losing ground or if they're doing very well but in a declining industry, either of these could be concerning and could raise red flags for you. Now, simply by diligently applying these investigative tools, investors are able to navigate through this maze, or through these confusions with more confidence, and they'll be able to significantly reduce their exposure to value traps. This type of analysis will help you protect you from superficial bargains, and it will enable you to identify genuine opportunities that will be aligned with your long-term goals. Now, two notable examples of value traps since 2010 are BlackBerry and Sears. So BlackBerry Limited, it was formerly Research in Motion. Now, it looked like good value, it appeared to be a fantastic value investment opportunity for several points and several times since about 2010 because of a low price to earnings ratio. It appeared to have a good strong balance sheet, and it had an iconic, well-known, globally recognised brand. Now, investors speculated heavily that the company was going to make a turnaround and that new product launches would pivot it and launch it towards new success, particularly as it tried to shift towards software and services. Why then would I say that it was a value trap? Well, they still failed to innovate, and they failed to keep up with their key competitors such as Apple and Samsung within the smartphone market, and this led to a decrease in their overall market share. Now, despite their shift to software and to securities solutions, their revenue just continued to decline. And so, as a response, the stock failed to recover substantially, and investors then that were hoping for a turnaround were instead caught in this value trap as the underlying business fundamentals continued to deteriorate. What about Sears? Well, Sears Holding Corporation looked like an amazing opportunity. They owned the Sears and Kmart retail stores in the US, and they looked like they were trading at great valuations based on their underlying assets, based on an extensive real estate holdings and these very, very well-known brand names. Now, some investors believe then that the company's extensive property portfolio alone was worth considerably more than the market value, and therefore the stock seemed really undervalued. So, looking backwards, why then might we say it was a value trap? Well, they suffered for many years from underinvestment. They suffered from a failure to adapt to this changing retail landscape and increased competition from both online as well as from other brick-and-mortar retailers. And despite the considerable value of the real estate that they held, their retail operations just continued to hemorrhage money, and this led to a pointy liquidity crisis. So the company filed for bankruptcy in 2018, and this made their stock virtually worthless. So investors who believed that the company's assets would provide a floor, a lower level that the value of the stock couldn't go below, well, they found themselves caught in this value trap as the ongoing losses basically blew out the value of those assets. So when we look at these situations, we can see companies then that could be value traps because of their declining market positions, or when they're stuck within an industry that's facing structural headwinds. And so we need to look beyond just valuation metrics and some of these key metrics around the business fundamentals to avoid such value traps. So as we can see, avoiding value traps is going to demand more of you than simply focusing on stock prices, than simply focusing on metrics such as price to earnings ratios. Consistent growing earnings. Now these are the hallmarks, my friends, of great, strong financial health. Erratic or declining profits should, on the other hand, raise some red flags. Sustainable dividend payouts, backed by robust earnings growth, this is going to be crucial. On the other hand, lofty yields that are unsupported by powerful profits should be a signal to you of danger. Debt against industry norms can show indicators of early financial distress, and understanding that competitive position and the overall sector dynamics is going to be helpful to avoid companies facing decline. By diligently applying these analysis forms, you're going to equip yourself with the tools to actually sidestep the quickstand here in the financial landscape and enable yourself to make informed decisions that will contribute to building a robust and profitable portfolio. So, my friends, hopefully this look at value traps will help you as you navigate through your investing journey and help you avoid what might at first glance appear to be an enticing bargain and avoid what would potentially then be an expensive lesson in disguise. So, look, embrace this holistic investing mindset, and I think you'll be well on your way to investment success.